What if I told you that one of the key rules with retirement investing could be plain wrong? So much so that it could cost you thousands in retirement if you fall into the same investing trap. One that frankly billions of pounds are invested in. If you don't know me, my name's George and I'm a chartered financial planner and a fellow of the Personal Finance Society. I've helped thousands of people retire without worry. And in this video, I'll be telling you specifically the myth for retirement investing that most believe, the new research which debunks that myth, why despite this, you might want to ignore the research, and what my thoughts are having advised thousands of people. Okay, so what is this retirement myth that most people believe? Well, it's all based on the principle that as you get older, you should gradually reduce your exposure to equities and increase your exposure to bonds. The conventional wisdom is that you take 100 and then minus your age, and that should be your stock and bond allocation. So if you're older, say 65, then 100 minus 35 is 65, which means you should have a 35% stock allocation and a 65% bond allocation. And the reason behind this is twofold. Well, bonds are normally expected to be less volatile. A case could be made because of that. It reduces sequence risk. And what sequence risk is, it's the risk of a bad set of investment returns having a disproportionately large impact on how long your funds last in retirement. Basically, if you draw down on your funds when the markets are down and you need to get the growth, they deplete faster. So we have to be very careful on that in retirement. And the second argument I hear is the preservation of capital argument, that stocks are inherently riskier than bonds. So in reducing your stock exposure, you're providing more security and peace of mind. And there is some science behind this. A company is required to pay their bondholders, but they've got no obligation to pay their common shareholders via dividends. So it is absolutely possible in the bad times for companies to suspend dividend payments. Whereas not paying your bondholders is defaulting on your debt, which has loads of negative knock-on consequences. I refer to this article from the FT from 2020 mentioning the dividend drought, which occurred when companies cut their dividends during the pandemic. All this is just to say there is an argument that there's more security in bonds, even if the most recent experience when interest rates rose so quickly in 2022 feels like it goes against it. In fact, when we look at this visual from Visual Capitalist, we can see down the middle and is increasing stock allocation with the best year on the right and the worst on the left. And as you can see from 1926, the higher the stock allocation goes up in your portfolio, the more volatile the portfolio is going to be, the better the good years are going to be and the worst years. The big downside with de-risking, as you called it, is you would reduce future returns as you'd be expected to, because bonds over time are expected to return less than stocks. But as a retiree, you have to have one eye on inflation beating returns and the other on trying to preserve as much of your assets as you can, or at least that's the argument made for de-risking. But do you think this holds up? Well, if you don't, then it's not just you. Academic finance is actually starting to push back on this. In a recent paper called Beyond the Status Quo, a critical assessment of life cycle investing advice, the opening lines, and I'm going to quote this because it's big, we challenge two central tenets of life cycle investing. One, investors should diversify across stocks and bonds, and two, the young should hold more stocks than the old. So when they looked at the research, the issue was that when they were looking at historical research, most people's lifetime is basically 75 years or longer. And the relatively short period of US financial markets and global financial markets presents an extremely small sample problem for kind of really long-term returns. So to combat this, they had to use a bootstrap simulation, basically using a large data set on returns of domestic stocks, international bills and so forth. And it spanned 38 developed countries and nearly 2,500 years of country month return data. So what was the results? Well, when they evaluated the strategies, they looked at 4 key outcomes. 1, wealth at retirement. 2, retirement income achieved. 3, conservation of savings, as in not running out of money. And 4, bequests on death, what you leave. Anyway, on average, the researchers found that 100% stock exposure produced 30% more wealth at retirement than stocks and bonds combined. And to accrue the same amount of money in retirement, an investor gradually blending into bonds would need to save an extra 40% more than an all equity investor. Now, this is big, but isn't that surprising? Because basically what we're saying is that the higher volatility portfolio has performed better. That's not really a shocker. What really is the shocker, though, is that a portfolio that transitioned from stocks to bonds, as in de-risked over time, came out with a 17% chance of running out of money entirely. So not too bad, less than 1 in 5. But for domestic equities, the risk was actually similar, or 100% equities. But if investing in 50% domestic equities and 50% international stocks, it produced a relatively much smaller 8% chance of running out of money. So just to double click on that, this is saying that the research that the stocks gave 30% more wealth to the upside, while also reducing the potential of running out of money on the downside. One of the explanations that the author uses is that the international stocks have provided protection against domestic inflation. But the researcher also did say that investors are less likely to suffer ruin than if they didn't invest in bonds at all. So I want to be clear here, equities are the growth engine of the portfolio. So they're going to be the thing that builds long-term wealth and arguably maintains it. And when I'm having these risk discussions with clients when we're determining their risk level, I kind of point to this graph because I like it. It's from JP Morgan, and it shows the real return, as in the return after inflation of UK equities versus bonds and cash. And this time horizon is way longer than any of us will live, but it assumes £1 in 1900 all the way up to 2022. And after inflation, what your pound would be worth now. If you invested in UK companies, the great companies of the world, arguably, you'd have £395 after inflation. In bonds, 4, and in cash, you'll have 2, just doubled your money. But if we just focus on what that represents, look, money is freedom and choice at the end of the day. It's being able to help your kids with a house deposit, perhaps working when you choose. That gap between the green line and the blue and the grey, in my view, represents opportunity, freedom. So this all seems pretty conclusive, doesn't it? So why then, despite that, do I acknowledge personally for my clients that 100% equities might not be right for most people? And I think it comes down to 2 key things. Here's the first. I think we need to be really honest with ourselves about how bad equity downturns can get and really search our own feelings for this about how we'll feel when we retire. That's not to try and scare you, but it's one of the reasons why I'm here is to make sure that my clients stick to the plan and of course try and get the returns they deserve from the market. But the problem is in a video like this is that when we talk about the market going down, it's an abstract, isn't it? Some event that just doesn't feel real. Yet when the market actually goes down, and yes, it's a when, not an if, it comes along with all the doomsdayers who always come up and try and show this as an opportunity to say they were right, even though they've been spouting negativity for years now. Anyway, so they do their broken clock regime, and it does often come alongside genuinely concerning events like global pandemics, or maybe the worst financial crisis for most of us in living memory. Everyone remembers 2008. So when I show you this, and it shows inflows, or more accurately, outflows, you can see that actually for a lot of investors, when the market pulls back, almost predictable as anything, funds experience large outflows. And what this represents is the worst of all things. It's people pulling their money when the market is down, effectively selling at a loss. There's a great Seth Klarman quote, who's a really famous investor. And he says, "Markets are inefficient because of human nature, innate, deep-rooted, permanent. People don't consciously choose to invest with emotion. They simply can't help it." And that goes for all of us, me, you, everyone. So the first issue is just potentially not having the stomach for 100% equities and subsequently making a bad decision. It's not about trying to hide behind bluster or whatever. It's just a really honest question to ask yourself if you go 100% equities. Search your previous experience in 2022, 2020, or 2008. How did you feel when that happened? Or more importantly, what did you do or not do? Can you really avoid making the mistake of getting built up in that, especially if you're not working? But the second question I think is important to ask is, well, okay, how bad, based on the history, can it get? If we look at the US and UK market, this shows the inflation-adjusted worst periods for the equity market. The 6 worst episodes contain world wars, Great Depression, and the oil shock in the 70s. And let's just sit on the magnitude of that decline for a second. The lighter declines were 18% to 33%. And the more significant were all the way up to 70%, with both US and UK markets having times when the decline exceeded 50%. So let's imagine you had £1 million portfolio, you lived through times like that again, and you saw a £500,000 real terms drop. And I'm not saying this to scare you or put you off. I think it's just about being honest about the real history of the market. There's no opinion here, only data. What's interesting is that if we compare the US data on stocks and bonds declines with the stocks in red and the bonds in grey, you can see that both actually do experience significant drops, with the stocks showing the deepest decline, but in grey, you can see the longest decline is actually the bonds, which makes sense because it's real returns and bonds do really badly in inflationary environments. The second issue is perhaps not of stomach, but more of desire. And I have some clients who are at the financial finish line. In fact, when we complete the cash flow model, it becomes clear that at 60-70% equity content, because of good planning, they've got all the money they need and a good level of headroom exists at that risk level. And, look, a spoiler, a big part of planning is making sure we look at unforeseen things that happen as well. But they don't necessarily need to jump from 60-70% equity to 100. And you might be thinking, well, why don't you just go 100 anyway? Make more money, more freedom and choice. That's what you said a few minutes ago. Well, let me show you this. In a lot of my videos, I go over sequence risk, as in the bad set of returns impacting how long the funds last. And I discussed adaptive spending, as in if the market's down, dropping down your expenditure. The thing is, the higher the equity content, using history as our guide, because it's the only guide we have, the longer duration the downturns are likely going to be. So to speak, the less forgiving the bear market's going to be, and the more likely that you're going to need to potentially change your plan, as in change your holiday plans in retirement, change what you can potentially do to help the kids. If things go really bad, the higher the stock allocation, the more likely you are potentially going to need to adapt. If you have a look at this great data from UBS, which shows the US market since World War II, and I'd love to have full globally diversified data for this, but I don't have that level of data. It shows being invested in large cap with the remainder in US government bonds. And as you see, as the stock allocation goes up, the depth of the decline increases. It shows being invested in large caps and the remainder in intermediate US government bonds. And as you go up the stock allocation, the depth of the decline increases, but so does the duration. And it's those two elements that matter so much, because they're what really are going to affect your need to adapt your spending in retirement. With the worst period being a 51% decline that lasts 6.2 years to return to the previous peak, yet a 60-40 was a 30% decline and 4.2 years. So if you're bucketing your cash, that's just an important thing to bear in mind, isn't it? So why does all this matter? And I think it's just really important to be honest with ourselves about risk in retirement. At the end of the day, you only get one retirement, and it is obviously very important to you. So to say, from 60 to 65, go on the big holidays, to really have the great early years that you've worked for, then I think it's a question of what you're trying to optimize for. Are you trying to optimize for making more money or optimizing for the result? And the thing is, I'm here to advise and support my clients, not just to nod along. I personally am in 100% equities, and my view is generally I want my clients to have a higher equity content if they can, because based on all of history, I know that's going to provide a better return, and money is opportunity. And it's my job as a professional to help support those good outcomes. Of course, there's no guarantees with investing, but all the evidence supports that if you invest in the right way. That said, I also think there's an honest conversation to be had about how bad things can potentially get during downturns, and not making my clients feel guilty if they would say, do you know what, a 40-50% decline, I'd really struggle with that. I think I'd rather move things back slightly and maybe not go 100% equity. Like anything in life, investing and retirement planning, it's about what's right for you, not necessarily what's right for somebody on YouTube or your neighbor or anyone else. So I'd be really interested to know, are you in the comments, my audience, are you in 100% equities or not? Tell me why. But before you go, I bet you probably wondered once what the average UK retiree spends in retirement. Well, it's actually one of my more popular videos, and it's got the perfect answer for you where I've looked at the data. So maybe give that a watch. Thanks for watching.